Hey, in this problem, we're going to work exercise 10-10A. If you haven't already, please read this part right here. It's the problem. It's also found in your book. Okay, so I assume you read the problem. Identify upstream and downstream costs. R&D is your upstream cost, $8 million, right there where my mouse is. Downstream cost, distribution, packaging, shipping, and sales commissions, $8 a unit. So that's the answer to A. R&D is upstream, distribution, $8 a unit, downstream. Second part of the problem says, hey, go ahead and calculate, or B, part of the problem says calculate cost of goods sold and then an inventory balance. Well, I'm going to look at it both with units and dollars. So they said that they made 440,000 units. Doesn't mention anything about beginning inventory, so we will assume there is no beginning inventory. Now, it asked us to calculate cost of goods sold and ending inventory. And let's look at units first. Well, we're told they sold 400,000 units. I don't think I said that right. 400,000 units. So if you plug in for that number right there, where I just drew the box, that's obviously 40,000 units. So ending inventory is comprised of 40,000 units. Erase these, and that'll give me the perfect room to write the next one. Cost per unit was given to us at $45 a unit. And that applies to both cost of goods sold and ending. Again, because we didn't have anything from the beginning inventory to deal with, and that would have complicated things immensely. And let's stay away from that, okay, guys? So cost of goods sold is $18 million. 400,000 times $45, $18 million. Ending inventory, 40,000 units times $45, $1.8 million. So that's B. Done. And we'll talk about what that gap means when we get to number 4 or D. Determine the sales price that Rooney desires to earn a profit that is equal to 25% of the total cost of developing, R&D, making $45, and distribution $8 per unit. And it'll be 25% of that cost. So let's get that cost, and then we'll go from there. Well, we already talked about it, that R&D was $8 million. And I'm not going to scroll. Well, here it is. I can just do that right there. Based on that R&D cost, I think they can make about 2 million batteries before they have to just, step up to the plate and redesign a new battery. And they might be able to do some innovations, right, and extend the useful life, or they might have to come up with something new, but really new and improved battery. But right now, based on the information, we know that the upstream cost or developing is $4. So upstream cost $4. And that's per unit. Per unit. Upstream cost $4. And then product cost per unit is 45. Let's don't do the dollar sign. And then downstream cost is 8. And that was, again, we pointed that out earlier. When you add those up, you get $57. Okay, not bad, huh? And it said that we want profit to be 25% of that 57. So multiply that times 25% or 0.25, you get 1425. When you add 57 and 1425 together, you get a price of $71.25. There is a faster way to do that. Because say you're on the test and you're not preparing something that, that just to be submitted, right? It's just crunching numbers, or you're not doing a report for your boss, right? You could have taken this 57 and multiplied it by 1.25. So 57 is 1 times itself, and then after that it's this part right here, and then you would have gotten 7125. A whole lot faster than that. So that's the price. That's what they asked us for in C. Determine the price, 71.25. Now it says, okay, you got the price, you got the cost of goods sold, you got the ending inventory cost. Prepare a gap-based income statement for year 2. All right, well, let's do it. So we got sales, revenue, and that's going to be 71.25 times how many of the units they sold. So it'll be 71.25. Now we wouldn't write this on a real income statement, but for teaching purposes we will. 71.25 times 400,000 gives you $28,500,000. Cost of goods sold, we're not going to recalculate that. You can go back and look at your notes or rewatch that part of the video. 18 million, and that gives us gross margin. And as I write this income statement out, keep in mind that this is the gap-based income statement. So when you see cost of goods sold, this is the gap-based income statement. Now we're going to be expense per gap. When we do the gap income statement, R&D is expense, is a period expense. So subtract R&D, and then selling expenses, distribution, downstream cost. And we haven't done this one yet, so let's do it. 8 times the number sold, not made. Not made. So $8 times 400,000 is 3.2 million. Okay. And that gives us, we'll have net income in this one. It looks like, no, we're going to have a net loss. No, we're going to have a loss, like 700 something thousand. Is that right? 10,000 minus 8 million minus 3.2 million. Yes, 700,000. That can't be right. Is that right? I just did it in my head, and it doesn't look right. Well, let's do it. Let's make sure. I'm pulled out my calculator. Yep, that is right. Pretty good. All right, so that's a net loss in parentheses. We'll put parentheses here. So parentheses around the loss, parentheses here, so we know it's a loss. All right, so that's the income statement. Now let's talk about the different sections in this income section, this income statement. So this is sales minus product costs. This is period expenses. Now, there really is a third place, and I don't want to really get bogged down into details that we don't need for the test, but this really isn't net income. This is more like earnings before income and taxes, or EBIT. Some of y'all probably have heard of that, maybe EBITDA, EBITDAR. EBITDAR is non-GAAP, okay? EBIT is, and this is really the EBIT number, because before we have to drill down to our income number before we can determine what tax is. And then we always have interest at the very end. So interest, and then we have a subtotal, and then we subtract out taxes, and that gives us net income. And again, until we file our tax return, that that income tax number is a good estimate. All right, is that it? Surely we've done everything, haven't we? No, we got one more. Given the price was established using upstream, midstream, downstream costs, why does a gap-based statement require prepared in requirement D show a loss? Okay, so if we hadn't shown that R&D, if we could have like capitalized it and written that cost down over time, then it wouldn't have been a loss. I think that's about everything I could think of. It's really a timing difference, right? If we could have spread that cost out over time, the benefit of the R&D over time, over the sales of the batteries, it wouldn't have been a loss. So if you look at this, right, they're very profitable, very profitable. We just expensed the whole thing as R&D. All right, this concludes the video. If you have any questions, please email me.